back to another video. Today we're going to take a look at the NASDAQ 100 from an order flow fundamental as well as a technical perspective. So firstly, we can see over here that US stocks are quite up. The NASDAQ's up plus 2% for this for today, getting back some of the losses that it had. And we can also see here Russia says it's begun to pull back troops from the Ukraine border. NATO urges caution. And I think for the past couple of days, everyone had their say to this story. One person said this, the next person came out and said that, and the next guy said that. And that obviously caused some uncertainty in terms of volatility in the market. We saw gold wanting to break out new highs. We saw the price of oil rally as far as it can, and then all of a sudden, everything was just stopped, and then the markets just pull back. um, and and most of this was energy and the gold prices as well, but the NASDAQ 100 was not pulling back 100% based off that, because if that was the case, we would have probably seen a bigger pullback in the market as opposed to the 2% that we are seeing today there as well, because we know that the market fell more than 2% even before this whole thing started, before with the situation between Russia and the Ukraine there as well. So let's take a look at the NASDAQ 100 from a technical perspective. Now, starting here on the monthly time frame, what do we see? Firstly, we can see how the market had printed this strong level of support. The market also printed this level of resistance, broke above that, came to test it as support. By doing so, the market also printed this level of support. Now support had hold because we had not get a candle that closed below that level there as well, but this level is acting as a strong level of support, and this is acting as a strong level of resistance. Now this resistance became support when the market broke below that, and this level is support that is now turned resistance, although the market is still trading uh, in alliance with that from a monthly perspective. Now, here on the weekly time frame, what do we see? Now, from a weekly perspective, we can clearly see how the market printed this important structural level that year that acted as a level of support. Now, when support got broken, all of that support became resistance, and we can see how the market gave us still multiple liquidity wicks as well. Also, if you take a look to the left, you can see this is the level that I was talking about, which is acting as a level of resistance that is now turned support. Now we can see here for the past 1, 2, 3, 4, 5 weeks, the market has just been stuck within that phase of consolidation there as well. Now, if you drop down on the excuse me, if you drop down on the daily time frame, what do we see? Now, yesterday I did a breakdown on the NASDAQ 100 when the market was sitting at this level, explaining all of the reasons for why we want to see that move to the upside. And you can check out my Instagram where I publish this video for a further reference. We can also see how the market printed this information. Now, after the information, you expect to pull back to the neckline, which is exactly what the market gave us. And from here, we could potentially see the market melt to the downside. The market will also give us this impulse. After an impulse, you expect a correction, and the best way to measure that correction is by taking your Fibonacci there from the high to the low, and you can see how the 0.50% is lining up perfectly with that structure, which is also the neckline of the information there as well. So we can definitely expect the market from where it is now to pull back lower, because like I said, from a weekly perspective, the market is currently stuck within a consolidation phase, and we can also see on the minus 27 is lining up perfectly with that level of support that the market had created there excuse me, as well. Now we can also see we had the PPI data came out for the US dollar at 1%. Now, if you don't know what the PPI data is, so it's basically the producer price index, which is the official measure of the producer price in the economy of the United States, which measures average changes in prices achieved by domestic producers for their output. The PPI was also known as the wholesale price index way back in the days. Then last year, well, in 2020, the price stood at 194.3 as well. Now, the main reason, well, the main thing that we are looking out for is right here. So this is an article by Al Jazeera. It says here, stock slide on Federal Reserve hike fears. Now, that is the most important thing for those of you that like to trade the NASDAQ. This is the most important piece of news that we have over here. Yes, this is good for energy resources like the US oil, because Russia holds about about between 12 to 14% of the world's oil reserve, and that's why the knock-on effect on oil was that much, as opposed to the way we saw the stocks slide there as well. The article further reads here, United States stocks opened low on Monday as investors were already rattled by the fears that the Federal Reserve could hike interest rates aggressively. Now, you see this move that you saw over here. Now the US interest rates were quite low at 0.25 for as long as it's been now. So if and people were out there spending money, which was good for these companies, because the NASDAQ 100 is a composite that is made up of the 100 top tech companies in sorry, in the USA, which is Apple, Amazon, as well as Tesla, Microsoft, and Google. Now most of these tech companies make money by consumer spendings, and the consumer debt for last year is sitting at 15 trillion at a 0.25% interest rate. So all of that debt, when the Fed comes in and they hike interest rates to 0 point with another 0.25 basis points or 0.50 basis points, at the end of the day that debt needs to be repaid two times compared to what it is. So if you are a citizen, or if you are, yeah, so if you're a US citizen that's got debt for a home bond or a car, then if your interest rates go up, you are less likely to go out there to make new debt, because you are already going to struggle to pay your current debt. Also, because of the prices of oil that had went up, that's also going to impact the pocket of every US citizen in the middle and low class there as well, which is less likely going to educate people to go out there and spend more money, because they will not have any money to spend. So if you look at the way that inflation had raised rose within the couple of well, between last year and now, and the way the wage had increased, and the wage had not increased at the rate of inflation. So inflation, although they're saying that inflation is sitting at a 7.5%, we know that inflation is a lot higher than what the Federal Reserve wants the market to believe there as well. Now, the main reason why we're bringing this up, because a lot of people think that the Nasdaq had pulled back because of the tensions between Ukraine and Russia. It is slightly because of that, but the markets are still very skeptical, because they expect the Feds to hike the rates more aggressively, because that has a bigger impact on the Nasdaq or on the stocks in general, as a war between the Ukraine and Russia as well. Now, US inflation is high, consumer debt is high, the US debt itself is very, very high as well. So we can definitely expect the Federal Reserve to hike interest rates more than what Paul said in December about the three times or two times. We could see it four times and five times. And if the CPI increases, which is the inflation rate of the US, you can just expect them to keep hiking interest rates. So the next thing we are going to look at the next thing that we are going to look at is the COT data, so the commitment of traders, and this tells us what the big banks and hedge funds are doing in the market. Now we can see here, based off last week's report, how hedge funds came in and they closed minus 4,137 longs. They also closed minus 13,098 short positions. Sorry, yes, short positions. Now long positions referring to buying positions, and short positions referring to sell. And we can see how the overall net positions increased from minus 989 to 7,972. And we can obviously see this week how that numbers is pulling through for the Nasdaq. But whenever you look at a COT report like this, where the biggest speculators close longs and shorts, that's normally when the market is stuck within a consolidation phase, and that's basically exactly what we see on the Nasdaq as well. So we can definitely expect the market to pull back from where it is to go and hit that level, then move to the upside as well. We could potentially see this move play out up until the Federal Reserve announced the interest rate hikes. We also excuse me, I just want to see if we've got any other news coming through this week. Yeah, we've got the core retail sales, as well as the retail sales, and the FOMC meeting minutes for the US dollar on Wednesday as well. And once again, we could see the market react to that levels as well. But again, from where I'm standing now, good selling opportunity from where we are. We also have this 50% retracement. We've got the completion of the information, which is considered a bearish pattern from a technical perspective. We've got a 50% pullback, which is generally normal to see in any situation where you're looking for trading opportunities. It's a 50% retracement of this massive impulse that we had over here as well. Now, guys, thank you for your time. Thank you for taking up the opportunity to watch the video. As always, cheers for years.